tonight, and what we're going to look through, obvious, it's on the board here, ownership, practice value, practice purchase, looking at especially from the buyer's perspective. So I know many of you are practice owners. Most of the rest then are future owners, and I think it's good for everyone to hear the same thing. I don't change what we say based on who's listening. So everything in tonight is going to be relevant to all parties. For folks that don't know me, my name's David McCormick. The CVA after my name is Certified Valuation Analyst, not veterinary acupuncture. So I'm not a veterinarian. My partner, my father, Larry McCormick, is a veterinarian of the team. He owned 2 practices here in Pennsylvania, where we're located, State College. And about 20 years ago, he and I started doing practice valuations, actually 22 years ago, and with a focus on management and planning and guidance. And for those that were at the Midwest Veterinary Conference, I had sessions yesterday and the day before on that. It's pre-recorded if you did register. In 2003, we joined Simmons and Associates, and we started doing valuations not only for management and planning, but also for transactions. And the last 20 years plus is what's led to this session. I think education is key, and we want to go through that. So what we're doing tonight, just as the ground rules, as I mentioned, the Q&A as we go through, I'll try to address questions, but I'm going to save time at the end, and I'll stay as long as people have questions at the end until Zoom kicks us off. So we're going to go through that, but if it's a burning question on any particular point, do use the Q&A portion. The other note on this, we are going to look at some numbers. So if you're looking on a pad or a phone, I'll draw your attention to the numbers of importance. Don't worry if you can't read it, but sit back and relax. After this session, you're welcome to send me an email. My email address is here. I'll put all the slides into a PDF, attach some more reading materials, and I'll send that to you. So first, certainly a disclosure. I do this for a living. This is my job. I'm with Simmons and Associates. I operate Simmons Mid-Atlantic and Simmons Great Lakes. For those that are not aware, Simmons is a veterinary practice sales and appraisals. It's the oldest firm since 1977 and the largest from there. This is not a commercial for Simmons. I'm about the content. However, need to know that that is my job. And I want to thank Simmons National for hosting this tonight and bringing me in to speak. So what we're looking at, we're going to be going through, starting with practice value. And I hope teaching you a few components, not how to value, because you don't want to do that. You don't like when your client's Dr. Google, you don't want to be Dr. Google valuing yourself. But I think there are key components that it is very important to understand. From there, we're going to go into the buying process, finding it, getting what kind of advisors, what are realistic expectations to go through as you move forward. So let's jump right in and start with value. I know folks are still trickling in, and we'll kind of catch people up if we need to do so. So when we look at practice value, I kind of want to jump back in time, because as I was preparing for this session, I came across this in my notes and I had to chuckle with this. But the third AHA meeting in 1936, this was the survey. And kind of shocking to look at where things were, $1.70 for the office exam, and you could start a practice for $2,500 was the estimate at the time. Now, you're lucky if it's going to be less than $250,000, $300,000. And in starting a practice, which is a common question, do I start a practice or buy a practice? I recommend buy, not just because that's what I do, but when you start a practice, you're borrowing a significant amount of money in hopes that you're going to get the revenues leading to the profits that will allow you to pay that debt. When you buy a practice, if it's fair market value, the profit must pay the debt. So all you have to do is keep the practice doing what it's supposed to be doing. The profits pay for the practice, the rent pays for the real estate, as we're going to go through and look at that more specifically. The other thing I found, Bob Lavoie, one of the early practice management consultants, very knowledgeable, super guy, wrote this text in 1969, the $100,000 practice and how to build it. Now, a one doctor practice, I have many one doctor practices that they're grossing a million, 1.3 by themselves, let alone. So it is interesting to see where we've been and as we go forward. So I want to hit, when we talk about value, fair market value first, and then we're going to talk about investment value and kind of potential value as we go into this. The value themselves, fair market value, as an appraiser, to me, this is defined by IRS Revenue Ruling 5960. It's the price at which something would change hands between a willing buyer and willing seller, both with full knowledge of the relevant facts and neither under compulsion to act. That's fair market value. That's not corporate value. That's not investment value, strategic value. This is the price when you have an individual buyer and an individual seller. This is the price where the practice transacts in real estate as well. In looking at value, historically, oftentimes it was using a rule of thumb. So 1 year's gross, or the average of the last 3 years' gross revenues. That was common. If you've heard the phrase 5 times the bottom line, that's the current common rule of thumb. The problem with rules of thumb is that they assume homogeneity, that all practices are the same. And that's not real. And not every practice is a 5, quote unquote. And not everyone uses the correct bottom line. So using that rule of thumb, you're playing averages. And that's a problem and risky. For example, here's 2 practices. Which practice would you pay more for? A, B. They're both grossing 1 million. They both have 200,000 in profit. 5 times the bottom line says that they're both the same value, right? That's the rule of thumb. Would this make a difference? Would you want one of these practices more than the other? What about some of the other variables? Does this make one practice worth more than the other? What if practice A went 1.2 million, 1.1 million, 1 million? Practice B went 800,000, 900,000, 1 million. They're both 1 million. They're both $200,000 in profit. All of these, it's just an example to show it's got to be more than just an average. Here's a scattergram of price relative to gross revenue. The line in the middle is the line of best fit. The slope of that line is the average. The average practice sells for 72% of gross revenue. How many of those transactions are on that line? Not very many. Yet I still talk with buyers that say, oh yeah, the seller heard the average is 72%, so he's going to sell me the practice for 72%. Someone's getting the short end of the stick. This is the line of 1 year's gross. Anything above that line sold for 1 year's gross. It's uncommon. 1 in 20, 1 in 25 practices that we see valuing about 100, 120 practices a year. It happens. It's just not common. So how do we assess value? There are 3 ways and only 3 ways to value anything. There's the asset approach, the market approach, and the income approach. The asset approach we do not use much in the veterinary profession. It's really a liquidation value because it focuses on the value of the tangibles. It's popular in holding companies, heavy equipment manufacturing, new construction, real estate, etc. The market approach, most people are familiar with that through residential real estate, using comps, or buying a used car using Kelley Blue Book, because they're looking at other similar transactions. And then there's the income approach, which is a traditional means of valuing a veterinary practice. So we're going to start there. The income approach focuses on the return on owning that business. What do you get for being the owner? You made the investment, what's the return? For those that have seen me speak before, you know when it comes time to financials, I got to dive back into the beginning. We're going to start a practice. To do that, you need money. And that money comes from one of two sources. It's either money that you owe by borrowing it or a liability, or it's your money, which is equity. You use that money to buy the assets, furniture, fixtures, equipment, the inventory. You put cash in the drawer, you open the doors to the public, practice medicine with your team, you have expenses. We're including you in the payroll. You're being paid for right up here. At the end, you have earnings, the profit. There are three things and only three things the owner can do with that money. You can pay down debt, you can put it back into the practice, or you take it out personally. Those are your choices. When this cycle first starts, the profits are pretty low, the earnings. So it represents reasonably a fair return on your purchase of all this equipment. If you put your money in a 6-month CD, 6 months later, you want your money back and interest, right? The interest is your return on having made that investment. It's a very safe investment, so that it's not a huge amount of interest. As the owner of this business, you took on the risk of buying all this expensive equipment, x-rays, computer systems, endoscopes, therapy lasers, and then you went and opened the door to let the general public into your facility, usually in a stressful situation with something they care deeply about, to interact with a team of divergent individuals that you brought together, practicing medicine. Any risk in this? Maybe. There should be a return. That's the earnings. So when that first happens, as I said, the earnings are low, and it represents a return on the tangibles. As the cycle continues, though, the earning continues to grow, and it becomes more than what we can say is a reasonable return on the fact that you bought an x-ray system and put it to work. So it must be a return on something else. It is. It's a return on the intangibles. This is your goodwill, your name, your reputation. Every practice has goodwill. However, that goodwill only has value if it produces a return, if it has excess earnings. In other words, profit over the return on the tangibles. We're going to come back to that. That's important. As a side note, for the future owners, I also like this chart because this is your financial statements. On the left side, we have the P&L, which is your tax return. How much did you make? How much can you write off? What do you owe taxes on? On the right side, we've got the balance sheet. So the balance sheet shows the value of the entity. What does the entity own versus what does the entity owe, the liabilities? Assets minus liabilities equals equity. You can think of that as net worth as well. The sum of what you own less what you owe is your net worth. This forms the foundation, and it's why the profit becomes so important. I skipped over that one slide that looked at reinvestment, which is key for profit. Practices that were profitable when COVID first hit, no problem. They had a cushion, they could adjust that before PPP came around. Without that profit, though, there's no cushion underneath the practice. So it's important management-wise, not just value-wise. Now, I keep talking about profit, 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 profit. In my head, profit means something different as an appraiser. I'm being very specific. The profit is the normal revenues, less normal operating expenses, fair compensation to the owner for his or her work in the practice, a fair rent if you own the real estate. That's the profit. The problem is tax returns and financial statements don't reflect that true profit. For example, here's a practice. This is a S corporation. It's grossing on the small animal practice just under 1.1 million in revenues. We have all of our variable expenses, so your drugs, medical supplies, lab, pharmacy, animal burial, cremation, etc., parasiticides, pet foods, doctor compensation. But on the tax return, there's no doctor compensation for the owner. That's just how the owner owns the business. So we make adjustments in the first step of valuing a practice. We review every line item and we look to remove non-operating things like adjustment A, the expendable equipment. This was the owner's husband bought a tractor because he takes care of the lawn and plows the snow, etc. It's not an operational expense. That's a personal expense paid through the practice. We also then had to adjust the compensation, the owner's work as a doctor. Based on how the owner paid the associate, we apply something similar to the owner. Just because you're the owner, you do not get paid more as a doctor. You get paid as a normal associate doctor. There's separate compensation, though, owner management compensation, because every owner spends time managing the manager, being the leader, evening, weekends, meeting with the accountant, etc. And in most practices, we allocate 1% to 2% of revenue, depending on how much work that the owner does versus delegate. Because the owner management compensation and owner compensation changes payroll, adjustment D, we had to build in payroll taxes associated with that. CE, meals and travel, was a little bit low. We bumped that up for industry expectations. Our goal is fair market value. So we're looking at market expectations. On retirement, pension profit sharing, right underneath that, we remove the owner's portion. The owner has control. The owner can do whatever the owner wants. So the owner's contributions are considered to be profit. And thus, then by removing that, that extra drops to the bottom line. On the bottom half of this income statement, we do have a rent and our facility costs, office expenses, banking charges, and on the bottom line, the profit. So the owner, based on her tax return, is being told her practice is 24% profitable. But that's not real. So we continue the adjustments. Yes, there is a rent, but it's high. The owner, again, has control, renting from a building that she owns. She can charge whatever rent she wants. We adjust that to a fair market basis. We remove some personal insurances. We put in lawn care and snow removal because that was the owner's husband doing that work. If someone else owned the business, they're going to have to pay for that service. Taxes and licenses, when we value the practice, we're looking at it as if someone else owned the real estate. And most commercial leases, the business is paying their share of the real estate taxes. So we built that in. We then removed under professional fees, there were one-time legal expenses and consultants. That's not ongoing. They're one-time, so we removed those, removed the cell phone, removed personal expenses recorded under miscellaneous. That bottom line then is now true profitability is 15% in this practice. As the owner, operator, landlord, you receive 4 piles of money. You operator, you get paid as a doctor. Owner management fee, sometimes these are combined. And then you get the rent and you get the profit. So when we talk about profitability, to give you a perspective, the average practice, think about the bell-shaped curve. That hump in the middle, the average practice is 10 to 12% profitable. We consider a practice to be financially healthy if it's 14 to 18% profitable. And then coming down the downside, half of all practices, 10, 11% profitable or less. That's a problem. Now, I talk with folks and they say, oh, this is such a crock. I took home 30% last year. Take home, that's the big pile. You got to take out this because you're a doctor, this because you own the real estate. What's left gets very small very quickly. So the first step in valuing any practice assessing any purchase opportunity is to assess the financials and look at what is the real profitability. Once we have that, we can come back to the valuation and we look at the income approach. We need two things: the profit, which we just talked about, and then the risk, that likelihood of the profit continuing. So the phrase 5 times the bottom line comes from right here. Bottom line, profit. The 5, if you invert 5, that's 20%. That's a capitalization rate. Dividing something by 20% is the same as multiplying by 5. That's the genesis of that rule of thumb. On the risk side, the appraiser is looking at the practice compared to not all practices, but practices that sold. And we're looking at these variables as they relate to the risk of the profit continuing and growing into the future. So this is the subjective component. The excess earnings method and the single period capitalization method are two of the most common methods within the income approach. There are many others, but these are the most popular. Historically, the excess earnings method was the first. In about 1984, 86, Owen McCafferty wrote the article in Veterinary Economics, and that started the train. The excess earnings method has been around since Prohibition. That's when the IRS created it. It focuses on taking the profits and separating it into how much is the return on the tangibles, and then how much is the excess, the return on the intangibles. Single period capitalization doesn't split the pile, just says this is the profit. So I want to walk you through this because there's a few elements, I think, especially for the future owners and the current owners working on evaluation, so you understand what's happening. So we have our bundle of assets. We're going to remove the cash because when you buy a practice, the cash stays with the seller. The buyer's going to get working capital. So we have our profit. In the excess earnings method, we'll start there. We take our profit, the earnings, $120,000. It doesn't matter what the revenues were. This is what was left over. Well, the revenues do matter because you got to have that to get to the end. But whether the revenues were 800,000 or 2 million doesn't matter. So we have our earnings. We need to separate how much of that was from the tangibles versus the intangibles. To do that, we have to value the tangibles. So what's your furniture, fixtures, equipment, all of that? What's it worth? Resale value. In this case, $120,000. A reasonable return, 12% per year, 10, 11, 12. Thus, the annual return from the tangibles is $13,200. We remove that from the earnings and we're left with $106,000 as the return from the goodwill. We can capitalize the goodwill to come up with the value of the goodwill. To that, we add the value of the equipment, and we have then the value of the whole, $585,000. Easy, right? Single period capitalization says it doesn't matter what tangibles you have, as long as you have what you should have. Thus, we have the profit, we have our capitalization rate, we have the value. So it's a much simpler process and significant. And the significance and the opportunities for error is why I only have one colleague who does the excess earnings method. Now, she does it very well and appropriately, but almost everyone else is using the single period capitalization. So opportunities for error, certainly in the profit determination. Remember, we made adjustments to the income statement. If you want an advocate appraiser, this is where they're going to find extra value or lose value based on how they adjust the income statement. Beyond that, you have your capitalization rates, and that's subjective with the appraiser. Now, some of you are already looking at that and saying, whoa, wait a minute. Why do you have 12% and then 20.5 and then 22.5? Why different capitalizations effectively? I'm oversimplifying, and it's the intent is correct. If you think about the return on the investment, return on pure tangibles, furniture, fixtures, and equipment, a weighted average blend of tangibles and intangibles versus pure intangibles. Higher risk, different capitalization rate versus lower risk. Oversimplification, but every benefit stream has a different capitalization rate, as does every practice. So that certainly. But this is why most people do not use the excess earnings. What's the value of your furniture, fixtures, and equipment? Big stuff, lab equipment, x-ray, yeah, we can determine that. How much are your surgical packs worth? You know, what about your computer system? Expensive to acquire, but doesn't retain much value. And yet this category, the tangibles, has double the impact. So when it comes to the two methods, they're both, when appropriately applied, they're valid and often should come up fairly close. However, that furniture, fixtures, equipment, inventory creates an issue. And that's why the single period capitalization is used more frequently. Now, one quick additional comment. I have seen many reports done by others. They're not credentialed. They're not a CVA or a CBA, where they take all the profit, they portion it into tangibles and intangibles, or I'm sorry, they take all the profit, they capitalize it and get the value and then add furniture, fixtures, and equipment. If you take all the profit and capitalize it by a multiple or by a capitalization rate, that includes the furniture, fixtures, and equipment. You can only add it back if you first separated the benefit stream. So when you see somebody take all the earnings, multiply it, come up with a number, and add furniture, fixtures, and equipment, they're double counting the furniture, fixtures, and equipment. So you'll want to watch that, because they'll call it the excess earnings method, but that's not what they're doing. They kind of don't know what they're doing. The market approach. So on the market approach, historically, we couldn't use this method because we didn't have the data. But over the last 10, 15 years, Simmons has been working to build the Simmons VetStats transaction database and working with Vet Partners Valuation Council. The Valuation Council is myself and 25 friends, colleagues, and competitors, all credentialed appraisers. We meet monthly to talk about valuation. It's great stuff. We love it. But we built this transaction database. So now we can go to that and say, okay, in the last 5 years, I want to find some comps, comparables, other similar practices, similar revenue size, similar level of profitability. Where did they sell? And that can come up. That method, called the direct market data method, can result in a value. We can also look at another market method, which is a regression model that looks at the model or the market as a whole, and that can come up with a value. We're using IPSIPL regression analysis. The two methods are equally valid. For comparison, real estate would be direct market data. You find 4 or 5, 15 comps and come up with a value. The regression model looks maybe selling a used car. You know, you're not looking for other 10 Toyota Camrys that sold. You're looking at all Toyota Camrys that sold. So this value needs the transaction data. For example, we have a subject practice, doesn't matter. I go to the data and I find 6 comps. And we look at the price to earnings ratio, price to profit, and the price to gross. Where did they sell? We can look at the distribution, mean, median, maximum, minimum, and see what makes the most sense. In this case, let's use the mean. We then bring in our data from the financial analysis. We had the price to earnings ratio, multiply that to the earnings, we get a value, and then take the price to gross ratio times the gross revenue and get a value. Then we can weight them based on confidence. Usually price to earnings gets a greater rate emphasis than price to gross. And that now we have a value conclusion. So to quickly walk through an actual case, and this is a practice, had two owners working part-time. They had an associate, it's a keeper. You know, if you were fishing, you caught it, it's a good one, you don't throw them back. And so they were considering a buy-in, but they wanted management and planning guidance as well. So we start with the financial analysis. In this case, we removed some income that had nothing to do with practice operation. We adjusted the owner compensation, what they paid themselves on the tax return, $212,000. That included doctor compensation, management compensation, and profit. We want to separate those into their own piles. So we have doctor compensation here, put in owner management compensation, adjusted the payroll taxes, put in a fair market rent. They didn't charge themselves a rent. Removed personal insurances, removed one-time remodeling expenses. We removed depreciation. That's non-economic. That's writing off past expenses. And then we put in the economic reserve for future reinvestments. We also removed the interest expense. We do this because when we're valuing a practice, we're valuing it debt-free. That liability does not transfer. So we have our profit. This is a financially healthy practice, 15.8% profitable. So now we can go from here into the valuation of the practice. We look at the income approach. Now, this is where, 5 times the bottom line is the oversimplification. Kind of like describing a spay. Well, you knock them out, cut them open, take some stuff out, close them up. It's a little more involved than that. And so is the actual application of the method. We have our profit, but we can't capitalize that by multiple or capitalization rate because that would come up with last year's value. We want the value going forward. So first we have to grow it by stable long-term growth, usually 2-3%. We then capitalize it and come up with the value of this practice from the single period capitalization method is $681,000. So then we shift to the market approach. We go to the transaction database. Now, this is a mixed animal practice. Most of what's in the transaction database is small animal general practice. So maybe not one-to-one, we just want to take that into consideration. We have our statistics from the financial analysis. We go to the database. We found 17 comps, similar size, similar level of profitability. As a side note, we had statistical analyses done on the database that geography doesn't matter. Your practice where it is versus located in upstate New York, from the investor buyer, doesn't matter. They're buying the existing location, the existing profit. Number of doctors, exam rooms, does not correlate to value. So in this case, we have 17, pretty tight distribution, 4.92 versus 4.81. So that's looking pretty good. We can use the means and the original data to come up with then that the value of this practice based on the market approach, direct market data, is $659,000. We then come to our reconciliation. We weight these. We gave the income approach greater emphasis because of a lack of confidence in our comps. They're good, but they're all small animal practices. And the reliance that most investors are focusing on the profit and the earnings, that the value of this practice is $677,000. Now, that's a real quick valuation process. Normally, a valuation, once the appraiser for us, once we receive the data, and I know this was one of the folks' questions, it typically takes 6 to 8 weeks to complete the process. Now, that's a full valuation. That's not a back of the napkin. We try to work as quick as we can, but we want to be right more than we want to be fast. So we've done them as quick as 3 weeks when we get all the data and all the answers really quickly. Typical cost for evaluation, most of the folks in the Valuation Council for a summary report is going to run anywhere from $2,500 to $5,000. So in this case, in this example, and this is where management plays the key and why we advocate practice valuations for management purposes. This was a healthy practice, but look at the trend in profitability. 19%, 17.9%, 15.8%. The owners had no clue they were losing profit. That's not sustainable. And that's why we recommend every 3 to 5 years on an ongoing basis, value your practice. Because we use this as a diagnostic tool so you can fix it. That's what they're doing. The other component of this was that they were looking at a buy-in. And this, we want to look at what's included in the value. Now, we focus on an asset value or the enterprise value. This is the value of the practice only. The determined value includes everything that was used to generate the revenues that results in the value. So the value includes furniture, fixtures, equipment, includes the inventory, includes the goodwill, and in a transaction, it includes a non-compete from the seller. It does not include leases, loans, liabilities, does not include the checking account. When you buy a portion of a practice, you're not buying a part of the practice, you're buying a part of the entity that owns the practice. The entity owns the practice and the entity owns the checking account and the emergency fund and the debt and accounts payable and taxes accrued, etc. So now we have to shift from valuing the practice to valuing the whole back on the balance sheet. So we look at the sum of what the entity owns less what it owes is the value of 100% of the shares. That's what you're buying 20% of when you buy into a practice. Another general comment on profit. In the last couple of years, EBITDA has become a very popular term, mainly due to the corporations coming in. EBITDA is an assessment of profit. So it's the earnings or the profit before you pay interest, as if debt-free, before you pay taxes, which is true for almost all practices anyway, and before depreciation and amortization. So that's essentially the profit. The key as we look at this, and certainly as profit goes up, value goes up. That it can go up, may not always. Ambulatory equine can be exceptionally profitable, or a mobile practice, but they may have different risks. So it's not always 5 times the bottom line, right? So the key, coming back to where we started, fair market value, I can buy, you can buy, anyone can buy. The veterinary lenders, as we'll talk about, are fine loaning the money. But there's also investment value. Investment value or synergistic value, that's a price to that particular buyer. So when a corporation comes and says, oh, hey, we'll value your practice, they're not fair market valuing it. They're determining what price would they pay for it. And it's a price to them. And the first offer is not their final offer. So we want to look at that, the general rules of thumb, recognizing that they're dangerous. Fair market value, the multiple, most practices, 4.2 to 5.5, bigger, stable, profitable practice, maybe 6. Investment value, how bad do they want it? 6, 10? I did a 12 and I did a 15 times the bottom line. And that's where the problem often comes in for exit planning. You want to sell it to your associate, but I'm getting 2 times that from a corporate. It makes it tough. And for you as future owners wanting to buy a practice, if you're looking at a 2 or 3 doctor practice or more where the owner is fine staying, you're going to end up having competition that you can't match, because it would be akin to paying $30,000 for a $10,000 car. Why would you do it? You just can't. So it gets challenging when we look at that. So I had a question there. The question is on adjusting doctor compensation, using a specific example. But one of the ways we look at that, when it's multiple doctor practice, we're going to look at how the owner pays the associates and then apply the same to the owner. When it's a 1.5 doctor practice, we're going to look at regional compensation. And in some cases, I do have practices that are located in places where doctor compensation is 16, 18, 19% of production. Most production-based equivalents are 19 to 21, maybe 22 is what we most frequently see. But what the question you ask is great because you're asking a question about the adjustment and not accepting the adjustment as fact. And that's the key when reviewing evaluation. Why was the adjustment made? And did they miss adjustments? For example, in Dad's practice, Mom did the books. She didn't get paid, but she did the books. Did the appraiser add a bookkeeper as an operating expense? If not, then there's missing expense. The profits are high, the value could be high, just as a general example. So now I want to shift into more on the buying side and for future owners, because that's really the core. How do you finding a practice? Once you found it, now what? And then what to expect on the transition. The first overarching comment, as you're looking for a practice, cast a broad net. The number one thing I run into is that buyers say, I live here, find me a practice within a 30-minute drive, I can't move. You might be looking for a practice for a long time. If you can move, maybe move 30 minutes, an hour, yes, you might have to drive an extra 45 minutes back to grandma's house, but you're more likely to find a practice. I have several great practices. Southeast Michigan, Northeast Ohio, all over Pennsylvania, in my territory. And I know all the brokers do. Great practices, but they're just outside of the popular area where people want to go. Indianapolis, everyone wants Fisher and Carmel on the north side of Indianapolis, but I have an awesome practice on the west side. So opening up, if you can you relocate, even an hour? Oftentimes that can make a difference in how long it takes to find a practice. So giving that consideration. Then get on the list with all the brokers. So Total Practice Solutions Group, Simmons and Associates, you can sign up on the practice watch list online, PS Broker. There are many brokers out there and many do good work. They all maintain lists of buyers. Some are more organized than others, but you want to get on their list. Also looking at where for sale by owners go. Typically looking at your state VMAs, your regional VMAs, VINs classifieds, AHAs, where they're listing their own practice for sale. And then certainly keep your ear out for what the rumors are. Recognizing, especially with the reps, they are rumors. So it may or may not be true. I've worked with other potential buyers, future owners that wrote letters to folks and asked to take them out for coffee, talking about their practice, how it goes. And by the way, do you have an exit plan? I like your exit, or I'd like to be your exit. So as looking in as many directions as you can to see what's going to pop up and explore that opportunity. The other component that I think is super important, when you find a practice, you want to make sure it's the right practice, not the right now practice. It may have a great location, but that doesn't mean that that's the practice you need to buy. So buy right practice. What I mean by that, is it practicing what you believe in or close to? I have clients that do high volume, low cost spay neuters. And on rescue cat day, they'll do 50 to 70 spays. For practice owners, future owners, you got a new grad, you want to get them some cutting experience, find a spay neuter rescue clinic, have them volunteer, pay them to be there. They're going to get good fast. And I have other clients that only do laparoscopy. It's $2,500 and they're booked out. There's such a huge continuum, but if you believe in this level, don't buy this practice. Those clients are thinking they're getting great medicine. They don't want what you have. And the staff, if you buy that and you start doing full diagnostics and pre-anesthetic safety checks and everything else, the staff's going to think you're padding the invoice because the previous owner never did that, and vice versa. So you want to buy where you believe in, pretty close to. And that's important. So let's say, okay, awesome. You found the practice you want. Now what? I do not recommend that buyers do an appraisal. I think it's the seller's responsibility to set the price. It's the buyer's responsibility to test it. Ideally, the seller is going to have a veterinary practice appraiser determine the value. However, they may have their accountant do it. They may just throw a dart at the dartboard and pick a number. That's fine. Buyer needs to test it, not do another valuation. And I'll talk about that here coming forward. But the other reason in for sale by owners, what you're likely to find, oh no, I didn't have it valued. I'm doing this with you so you can buy it. You go have it valued. No. They are not serious until they've had a value done. You could have the best appraiser in the world value the practice. When you present it, it's not going to match the number that's in the seller's head. So they need to hear what the value is from their advisor before they can commit to selling to you. And that's super important. Now, they may say, well, I'm doing this for you. You could say, I'm happy to reimburse you for it. I'll pay you at closing. Remember that bell-shaped curve of profitability. Half of all practices are not financially healthy. Their value is 45, 50% of revenue or less. And if the owner's thinking, I've got 70% of revenue and they're worth 30% of revenue, they're going to change their timeline. You don't want to pay for their valuation that turns into a management consult. So reimburse them at closing. So financial feasibility analysis, the purchase feasibility analysis is what I recommend for buyers. It starts at the same point that evaluation does. We have profit. On one side, an appraiser uses profit to determine the value. On the other, we use the profit to test the value. If you have another appraisal done, you're going to end up with a he said, she said situation. Well, my appraiser said it's worth, well, my appraiser said it. It's not going to get you anywhere. If you do a purchase feasibility analysis, it's grounded in the financial data of the practice. If it's not feasible, you're negotiating based on the facts. The feasibility analysis looks from the buyer's perspective, taking into account the purchase price, financing terms. If I bought the practice and I run it next year as it was run last year, I'm going to get the profit. Will the profit pay the debt and pay the taxes? If that's true, it's feasible. Go buy it. The lenders will loan you the money. Everything's great. If it's not true, now you're coming back to the seller and saying, hey, tell me where your data is wrong because I can't buy this practice. Well, my data's not wrong. Then the purchase price must be. It's the only other variable. So this analysis starts in 4 steps. We're going to walk through one. First, adjust the income statement like we do with it to determine true profitability. And then building in your forecasting assumptions. What's the current interest rates? What projection, what growth rate, et cetera. Make the projections and then look at the what ifs. What if the profitability was this instead of that? How comfortable are you with the numbers? So here's a scenario. We have a Schedule C sole proprietor practice, $688,000 in gross revenue. We make adjustments. We build in doctor compensation. We build in owner management compensation, adjust payroll, CE meals and travel. We adjusted the rent from a high rent the owner was doing as a tax strategy down to a fair market rent. Remove one-time expenses, remodeling expenses, remove personal cell phones for the seller's family, adjust the depreciation. The profitability of this practice is 10.9%. That's our foundation. Now, in all of these, I'm only showing 1 year. The appraiser, the analyst, is going to usually look at 3 to 5 to identify trends and better diagnose what's going on. So from here, we've got step 1. Now let's get our assumptions in here. So going forward, we're going to assume a 2% growth rate. The practice was 10.9% profitable, but we're going to go with 10% to be a little conservative. we're not going to put in buyer doctor compensation or owner management compensation. When we're testing the purchase price, we look at, will the profit pay for the practice? Will the rent pay for the mortgage? If that's all true, it's good. Now, when I'm selling a practice and I'm putting this together for buyers, I do add in the doctor compensation and management compensation so that they can see what's the impact to the household. But this is where we start. And then under here, we have financing terms. Now, the interest rates are high. This is a little bit showing the date. Interest rates right now are below 4%. I usually do use about 0.5% higher than current, again, to be conservative. So once we have this set, now we can go into the going forward perspective. Now I'm showing the baseline in year 1, year 2. In my chart, it goes out 18 years. Year 1 is the most important. After that, it's just, well, grow revenues by 2%. It's all math. So, but year 1 is the key. So we have our baseline. We grew the revenues by 2%, 10% profitable. The profit from owning for the first 12 months, the first year, was $70,000. Now, the next step, we look at all of the owners, the big pile, keeping in mind that we're removing doctor compensation and owner management. So the profit plus the mortgage for buying the practice and buying the real estate, you got $124,000. That's a lot. That's great. However, we haven't paid debt. We haven't paid taxes. Now, from here, we're going to calculate debt or pay the debt, then calculate the taxes. When you buy a practice, you get to write off the interest. So we separated the interest payments. We take those out first, then calculate the taxes, then remove the principal payments afterwards. So after debt, after tax, the buyer of this practice is going to have about $22,000 left over. In general, depending on the size of the practice, it can change, but for the typical practice, that bottom line after debt, after taxes, after all operating expenses should be ideally $10,000 to $20,000. This is a feasible purchase. As opposed to if we did that after debt, after tax, and it's negative $10,000. That means for you to break even, you'll need to put $10,000 of your own money into the transaction. That's not feasible. And now you can go back and discuss to look at that profitability. Now, I have had a transaction where it wasn't feasible, and the owner said, I don't care. I want $400,000. So now we came back using the model and said, how can we make it work? Even though the buyer knew he was paying too much, but he wanted that practice, everything other than price was perfect. So we started looking at the different terms and found out, well, if we did a 25-year loan, it would work. So he went back to the seller and said, I'll pay you $400,000, but you have to be the bank at 25 years at 2% interest. And interest rates at the time were 8-9%. Seller said, I don't care. I want $400,000. So it was almost one of those scenarios, as kids, you're going to share a brownie. One kid gets to cut the brownie. The other one gets to choose first. I have twins. So we do a lot of cutting brownies. But the other comment on this $22,000 at the bottom, that's after tax. So it's not comparable to a W-2. To have a W-2 for that, you would need to have $28,000 because a W-2 is pre-tax. This was after tax. So that feasibility analysis, I do like it for buyers because you learn a lot. It's ownership 101, learning about the financial statements, the trends, the analysis, adjusting variables. You're buying it with a partner, a classmate. Okay, we can adjust it instead of 100% to 50%. You can look at all of these numbers to make it really effective. So now let's get into the process. It's feasible. You found the practice, the purchase price is feasible. Now what? Well, we got our advisors that we're going to work with as we go forward through here. starting with the appraiser or broker that's going to do your feasibility analysis. It may guide you the rest of the way through the transaction. You're going to have an accountant. If you don't have a veterinary accountant, and there are many, vetpartners.org is the Consultants Association. There's veterinary of all of these. They can guide you. A local accountant can also be good if they have other small businesses, especially like dentists and chiropractors, which are very parallel financially to veterinary practice operation. The lenders I want to talk a little bit on as well. But first, a comment on the attorneys. If you are buying a practice, I strongly recommend working with an attorney that has veterinary transaction experience and not a local attorney and not family. Please, not family. They do not good attorneys make unless they are a veterinary transaction attorney. The attorney is going to guide you through more than just the offer and the letter of intent and the purchase contracts. They're going to help you create your entities, create your operating agreements, create leases, and work with the bank and help through the process in addition to all the things that I do. So you want that guidance. I think that's important. On the financing, one of the questions that comes up frequently is, well, I've got student debt. Do I need to pay off my student debt first? Nope. As long as you are out of school 2 or 3 years, living within your means, or better yet, below your means, so that you're saving some money and paying your student debt, then you are good. Because the veterinary lenders are cash flow lenders. They loan based on the business's ability to produce the profit to pay the debt. Local banks are asset lenders. They loan up to 80% of the value of the home, Kelley Blue Book value of the car. So they want tangibles. The cash flow lenders want a good borrower. So living within your means. I do recommend save $20,000 or more. You're going to get 100% financing. But the more liquidity you have, the more savings, retirement, equity in your home, et cetera, the more appealing you are to the lenders, and oftentimes the better terms you're going to get. The typical terms, 10 years for the practice, 20 years for the real estate. Oftentimes we do see seller notes, so the buyer is going to get 100% financing, but 10 to 15% of the total may come from the seller. It depends on the lender that's doing and what they do for the real estate side. If you see a transaction and the lender says, oh yeah, we can do the practice, if we use a 15-year loan, red flag. You should not need a 15-year loan for a fair market value purchase. You can choose to do a 15-year loan because that decreases your monthly payment, although it doubles the interest that you're going to pay over the life of the loan. But you shouldn't need a 15-year loan in order to get approval. Most conventional financing has fixed interest rates right now, 4% or below. And there's some pretty good aggressive rates out there. I do recommend when it comes to lenders, apply to 2 to 4 of them so that you can compare, contrast their proposals and negotiate their proposals. It's not cast in stone when they give that to you. So after the lender, most buyers will do, you found the practice, go apply for the loans first because that's free. There's no cost other than your time. Once you know you can get at least 1 or 2 loans, then you can start working with the attorney. That attorney, you're going to start spending some money. The first step is the letter of intent. The letter of intent is your formal offer, and it's important. I don't recommend skipping this unless you're buying from the owner and everything's happy, happy, joy, joy. But in a typical transaction, that letter of intent includes the purchase prices. It includes the contingencies, such as if you're buying the real estate, you have not had a real estate appraisal done yet. And usually you do not. The bank is going to do one. So you'll put in there, and $400,000 for the real estate, comma, pending the fair market value appraisal that will be done by the bank. Contingencies on the rest of your due diligence, contingencies on your ability to get financing. If you have to relocate, then you want that in there. If you're going to hire the seller post-closing, you want that in there. So your veterinary attorney is going to guide you through this. That document tends to go between the buyer and the seller a couple times before it's accepted. Once it's accepted, now we have a transaction, you have exclusivity. From there to closing is typically 3 to 4 months when real estate's involved. It can be a little faster if everything lines up. It can be a little longer if you have to give notice to your current employer. Once the letter of intent is accepted, at that point, you commit to one of your lenders, sign their proposal, send them a check, they get up and running. Then your attorney is going to prepare the purchase agreements, the asset purchase agreement for the practice, the real estate purchase agreement for the real estate transaction. Once those start going back and forth between the attorneys. As those documents get refined, confidence grows in the transaction. Yep, it's going to happen. Now you create your entities, one to own the practice, one to own the real estate. Your attorney and accountant will advise you on that. And then we're approaching closing. I do not recommend giving notice to your current employer until your attorney says, yeah, we're going to get this done. Then you give notice. Now, it's less common these days because good associates are hard to find. But I have had buyers' employers say, you're doing what? You're fired. Well, okay, no problem. Everything's done. We can move closing forward. These days, it's more, well, thanks for the notice. I need those 30 days, 60 days, 90 days. We just have to wait for the transaction. So the closing is the seller's last day of ownership. Buyer takes over at 12:01 a.m. the next day. You're a practice owner. Now, I skipped the main part, that whole due diligence component. Due diligence, up to this point, you've seen the practice, you've toured the practice, you've done the financial work, but you haven't really jumped in with both feet to learn more, spending time after hours in the practice, learning about the equipment. Does the x-ray machine work? And reviewing medical records. How do they chart things? Sitting down and talking with the owner about the team. If you haven't worked in the practice, most buyers do not work in the practice until they are the owner. You meet the staff 10 days prior to closing. So you're going to meet with the owner to talk about the staff, their strengths, their weaknesses, the opportunities, real estate due diligence. The bank is going to do the appraisal. You're going to have a building inspection. I do recommend building inspections, whether you are buying or leasing the real estate. If you're leasing the real estate, as the tenant, you're going to be responsible for maintenance and repair. So it would be good to find out, is there any deferred maintenance? Because you can use that for negotiating. If you're relocating, got to learn about the community, the schools, on homes. If you are relocating, I do not recommend buying a home right away, unless you know the town, the community. I recommend, for two reasons, finding a rental property for the first year. Reason number one, I just mentioned, you may not know, you could buy a house on the east side because it was available, and then 2 years later, shoot, I wish we were on the west side. The other reason is, for the first year of ownership, you need to be focusing on the practice and not thinking about remodeling the kitchen, landscaping, and everything else that come up when you're a homeowner. You can try and avoid it, but it comes up. So if you can defer that and really focus on the practice for the first year, that needs to be done. Other details to consider as we go through this, and this is kind of on both sides. On the real estate side, do you want to own it or lease it? Many practice owners and sellers are thinking, well, I want to keep the real estate because that rent's really nice. However, you own special use real estate. If you lose the tenant, can you find another buyer or another tenant? If the answer is yes, okay, you're good. If the answer is maybe not, then you're better off selling the real estate and doing a 1031 tax exchange. That allows you to buy another commercial real estate, like a single family home, that you can rent out easily and find tenants, and defer the taxes on the first sale. So your advisors can tell you more about 1031s. On the buying side, if you don't want the real estate, then you're going to do a lease. You want to make sure that you have the lease renewals. The banks are going to want to make sure that you have about 8 to 10 years guaranteed. So if you have a 3-year lease, you want 2 renewals, which means at the end of year 3, you just say, yes, I'm renewing. You got another 3 years. And that gives you that time there to put things together. I mentioned meeting the staff. Usually that's not until right before closing. The less time the staff know, the better. Less for them to worry about. Even if you're buying the practice where you are working, make sure that you keep those conversations private. Never talk about the transaction during the day when the employees are there. Meet early, meet after, go down to the local coffee shop, never on site. So you kind of keep it away from the employees until it becomes real. Prior to closing, I am a fan of both parties writing a letter that goes to the clients. It can be a 1-page signed by both, or it could be a front, back, front from the seller, back from the buyer. But that client letter is instrumental to transferring the goodwill. It's the opportunity for the seller to say, thank you very much. I've enjoyed being your other family doctor. I found an awesome new owner, blah, 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 Ginger, and an introductory letter from the buyer. I can't wait to continue the traditions of care that you've come to expect, and blah, blah, blah. But that letter, I call it a warm fuzzy. It's a warm fuzzy client touch as opposed to a cold prickly of the reminder cards. So crafting that beforehand, it's sent out after the closing. Now, I mentioned your entity, creating that, and you're getting that EIN number, which is a social security number for your entity. Once you have that, then you can open up your checking accounts and start setting up payroll, everything else to start becoming prepared. We're getting closer and closer to closing. Then you start setting up your insurances, business overhead insurance, professional liability insurance, not for you, for the practice. You'll need your DEA license, because you're going to become the veterinarian in charge and have to transfer the logs. MasterCard, Visa, setting up merchant accounts so that you can accept those. The seller is going to close all their vendor accounts, and you're going to open up all new vendor accounts and get new account discounts, new bank accounts, etc. On the post-closing component and transitions with that, the fewer changes that you can make, the better. I typically recommend for new owners, do not change anything for 6 months, maybe 9 months. You don't want to start twisting levers and pulling knobs on a machine that you don't know what they're connected to. If it's not a health or safety issue for staff or pets, or a team morale issue, negative client or negative team member that can't adjust, yeah, that you got to fire. But otherwise, try to minimize change. There'll come a day, usually around 2 quarters later, 6, 9 months, where you wake up and, yeah, the coat fits. I'm an owner. Nice. And you'll know that you understand things. Now you can start coming up with a plan to make change. As far as keeping the owner, if the two of you work well together and the owner's retiring, I do recommend it in the sense that maybe they come in a day a week. Now you pay them relative to production so that they're producing, but that day a week is not that you get a day off, you get a day on. They're there working in the practice as a doctor while you're there working on it as an owner. And that can help you manage the traditional owner work hours of evenings and weekends and be a little bit better structured. So I have some questions and I've got time here. I know I tried to keep it to an hour because I know everyone's got full schedules, but we've got questions. As long as they don't run by too quickly, I'll answer them. One of them, the first one here, do you have guidelines for what we should shoot for in terms of expense levels in order to ensure a solid bottom line? Most definitely. Now you mentioned rent at or below X%. Rent varies because that you don't necessarily have control over. But there are statistics. AHA's text, Financial Productivity Pulse Points. It's in their Vital Statistics series. That's where we get statistics. Denise Tumlin's Well Managed Practice has very good statistics as well. I'm working with a colleague, Louise Dunn, to make a user guide for the Financial Productivity Pulse Points. But one, just as an initial reference, your variable expenses, drugs, medical supplies, lab, parasiticides, pet foods, etc. Typically in a small animal practice, those should be 22 to 25% of revenue. If it gets higher than that, it starts consuming profit. But there are good resources for that, that better than this section here focusing on transactions. Please tell us again why you took the salary out of the feasibility study. Okay, so in the feasibility analysis, when we're testing fair market value, the pure test is, will the profit of the practice pay for the debt and pay the taxes? That's different from a household cash flow perspective. So in doing the analysis for your household, we're going to look at total cash flow. So we're going to say you get owner doctor compensation, owner management compensation, the rent, the profit. Now we're looking at the money that's going to come to your household. But the true test of a purchase price is purely, will the profit alone pay for it? That's why in the analysis I showed you, the feasibility analysis, I removed that doctor compensation and owner management because we were just testing the purchase price, not necessarily looking at your household cash flow. Is that after paying yourself out? So yes, when we adjust the income statement, we're paying everything. The profit is after paying everything. So we've paid you as the owner or future owner your doctor compensation. We've paid all the staff. We've paid all the operating expenses. That's the profit. The other way to look at the profit, if you own the business, but you lived, and the practice is in Michigan and you live in Florida, what checks are you going to get in the mail? So you don't work there, you're paying some other doctor. That's the assessment of profit when we're looking at it. Now in the feasibility, whether we add that back depends on which perspective we're taking for that. How do buyers pay for the expenses associated with veterinary lawyers, feasibility, etc.? These are awesome questions. Thank you. That is money out of hand initially. So again, you need to save $20,000 or more because you're going to be paying for the attorneys, you're going to be paying for the insurances. If you're traveling to visit the practice, that's money out of pocket, your pocket. You do want to keep track of that because once you own the business, right, you created an entity, the entity bought the business, you as an individual paid for all of that post-tax. That's household money. You've paid your income taxes. You can submit a reimbursable to your practice to pay you back. And then the practice is going to write all that off. Those are acquisition expenses. The practice can deduct that. So as for the future owners, as you're looking at opportunity and having expenses, keep track of those because you may spend money looking at 4 or 5 practices before you find one, but all 4 or 5, those expenses are acquisition expenses. So you can get reimbursed back to your household for those. Any recommendations on where one might source a veterinary attorney? Definitely. 2 recommendations for that. Vetpartners.org has, you can search the members and look for attorneys specific, well, I guess 3 resources that you can look. Vet Partners, that's where folks like Charlotte Lacroix, Trey Cutler, Peter Tonella, a lot of really good attorneys. For the sellers, if you are selling corporate, if you end up with it, I strongly recommend a veterinary attorney, like some of the folks I mentioned, Ed Guiducci, some of the others, because they have experience in those. The next level down are attorneys with veterinary experience. And that's the second recommendation. You can contact a broker. Most brokers, not all, I signpost all the time, meaning if you send me an email and you say, hey, I'm here, I need some attorneys. Yep, here's several. I always recommend in 3s. Call all 3. You'll find the one you want. But brokers, it can be a good resource. The third resource is VMLA, the Veterinary Medical Law Association. And that can be a good resource, not only for transaction attorneys, but also mediation and employment agreements, litigation, etc. There's a lot of good attorneys out there. Would it be possible to get a recording of this revenue or of this webinar? I don't know. It is being recorded, but I don't know how we're doing that yet. We still have to figure that out. So I hope so. But you can, after this, email me. My email address is here. I'll put all the slides, as I mentioned at the beginning, into a PDF, attach some more reading material, and get that sent out. For folks looking, I work in my 9 states, so I can't take most of you on as clients because you're across the country in Canada. But I do have colleagues I can connect you with. If you need an appraisal, I can send you 2 or 3, well, at least 3, that you can connect with. Same with lenders, attorneys, etc. Cost of the feasibility analysis, it's a little less than evaluation. I don't know my peers and colleagues, but I know for me, it's about $3,800. I expect probably similar to evaluation, $2,500 to $5,000 or so, depending on what's going on. You can also engage buyer facilitation or I call it buyer coaching. That tends to be commission-based, paid at closing, where I or another colleague hold your hand through the entire process. Oftentimes, the veterinary lenders will finance that because it's in their best interest. You're going to learn a lot and be better helped to pay the lenders back. Anything special to consider when you are selling to your associate who is your granddaughter? Most definitely. Now, I haven't done grandchild. I've done mother, son, father, daughter, father, son. I haven't done mother-daughter transactions or grandchildren yet. It is business. That's the #1 recommendation. You do not have conversations around the kitchen table, in the home. If you're having dinner, you don't talk shop. After dinner, you go and sit down and separate family and business, most definitely, and work with good veterinary advisors. Yes, it's more expensive, but the analogy that seems to resonate is that you're vaccinating the transaction against future issues by working with the professionals. So keep it business. Related to that, oftentimes, or well, what about non-veterinary practice owners? Can you sell to them? It varies by state, but yes, even in states that don't allow it, there are structures using an MSO who owns the veterinary component versus who owns everything else. The challenge for non-veterinary owners, though, if you're buying 100%, is I think 2 challenges. #1 is managing and working with the veterinarians. So having a chief medical officer, you work with that doctor works with the others, and having a really good Rolodex of relief doctors. Because keeping the practice running is #1. But in the acquisition side, the veterinary lenders will loan 100% practice and sometimes 100% of the real estate. However, they loan to veterinarians. So as a non-veterinary owner, finding the financing can be really challenging. And sometimes we have to look at seller financing to make that work. It can be good. Single doctor practices seem very goodwill dependent. The clients are attached to that doctor. How do you account for the loss of the goodwill? If the transaction is done right and you have a client letter, that goodwill transfers. Well, if the transaction's done well, you have a client letter and a similar standard of care, the goodwill will transfer, most definitely, especially when you keep the entire team. The client's experience, they arrive, they see the support staff, technician, doctor, tech, support staff, they leave. It's the continuity of the support staff and a similar standard of care, #1. I had a transaction, to take it to an extreme, I had a single doctor practice, and they're great practices. 1 to 1.5 doctor practices are great practices to acquire. The owner at the closing table, the buyer relocated from 2 states away. She did not meet the staff until 8 days prior to closing. At the closing table, the seller is literally looking at his clock and saying, "We have 30 minutes. I am leaving whether we're done or not." We finished on time. He said, "Here's the keys. Here's the security code. Don't call me. Email only. Goodbye. Good luck." Went straight to BWI Airport to catch a permanent relocation flight to New Zealand. No transition, but similar standard of care, definite plan, good client letter. She got in and grew by 18% that year. So Goodwill transfers as long as you have a plan on that and a non-compete with the seller. That's where the advisors come in. How far in advance of retirement do you recommend an appraisal to start? I recommend ideally 3 years, maybe 5, because if the value's low, you've got time to improve the value in replicable and sustainable change at a minimum, at least 1 year, 2 years before. If your value's perfect, great, you're set. Have fun storming the castle. But if it's not, that's where it's nice to have that extra cushion. Almost every valuation we do, half of all of our valuations are purely for management and planning. And almost every one, there are things we identify that pay for the valuation by orders of magnitude. How far should we make the exit plan? Yeah, definitely 5 years ideally. That's another session. Maybe we should teach one of those. How do you handle inventory and practice valuation? Awesome question. Remember, the practice value includes everything that was used to generate the revenue that results in the profit. It includes the furniture, fixtures, and equipment, and it includes the inventory at normal operating levels. So as the seller, they need to maintain the inventory. Now, the purchase agreement usually will specify a value for the inventory. And if it's less than that, then adjustment's often made or overly high. The other answer or comment on this question, in the purchase agreement, the purchase price, when we value the practice, it's the value of the whole. But in the purchase agreement, we do have to take that price and separate it out into subcategories. This is called allocating the purchase price. And we usually break it into an amount for the inventory, the usable and sellable cost to the practice, an amount for furniture, fixtures, and equipment based on resale value. You're going to insure it for something different. An amount for the non-compete covenant, an amount for the goodwill. Both sides have to agree on that because you're going to report that to the IRS. Profit must pay the debt. What is the ideal time of length and how many years is acceptable? The profit must pay the debt and must pay the taxes over a 12-month period is how we assess the purchase feasibility. Now, the typical loans are 10 years for the practice and 20 years for the real estate. If you use all of the profit to pay off the debt, in other words, you start prepaying, then yeah, the term is going to get shorter, usually down to around 7 or 8 years. The other component to consider too is as you own the practice, in the purchase feasibility analysis, remember we're looking at it conservatively, conservative revenue growth, conservative interest, profit, etc. So once you buy the practice and you start growing it, making changes, etc., the profit's going to grow quicker. And that does enable you to start prepaying the debt or setting it aside for that expansion or equipment or reinvestment. How can I have a copy of the recording? Again, that I don't know yet, but I can email you the PDF with the slides and reading material. How far should evaluation be done before selling to an associate? I do recommend before you mention anything to an associate, whether it's a buy-in or a 100% purchase, have the value done first. Because you don't want to say, yeah, I'm going to sell you the practice, and then I go and have it valued and my value is low. And now I have to come back to you and say, yeah, about selling you the practice, how's 2 years from now? So find out where you are, how you are, before you start having any substantive conversations with your associate. Of the 3 sources for a veterinary lawyer, what was the second source? Vet partners, the Veterinary Medical Law Association, and brokers, or any other practice management consultants, brokers, some of the veterinary lenders as well. So individuals that work in your target area. I cover Indiana, Michigan, and Ohio. I have attorneys in all three: Pennsylvania, West Virginia, Virginia, Maryland, Delaware, New Jersey, and I have attorneys for those as well. So if you're in those states, you can contact me and I'll send you 3 to get you started. I have a business in the home. Oh, wait, can you comment on confidentiality on the part of brokers when a potential buyer reaches out to you for evaluation? Well, for us, because I don't know everyone else, but we're a one-way street for information. If I valued your practice and now a buyer reaches out to have me test it, I can't say anything unless you give me authorization to say anything. So you have to protect confidentiality. Everyone needs to protect it. The buyer, the seller. Sometimes it does get violated. I had a transaction where the buyer's aunt was shopping at a landscaping store the next town over from the practice that her niece was buying. And she said, oh yeah, that's a nice practice. My niece is buying it. And told it to somebody working there whose sister was a client. And word gets out. Now we have to try and protect the confidentiality. So, protecting that is paramount, at least in our perspective. And we try to maintain that to the best that we can, because that's our business. I have a business in home. How's the best way to sell the practice and not the real estate? Single doctor, fairly large property. This gets tough. And I think getting some advice on that. I have a practice right now, great practice in the home, same situation. The seller does not wants to stay there. And so we need to move the practice. So, and we're trying to tie it with the transaction of finding a buyer. Fortunately, there's great options in that community, but it does create a mental barrier. Now it's overcomable, but it's still there. So as part of your exit plan, giving consideration maybe to move a year before or 2. Usually most practices, when you relocate, you get a surge. You have a new location, new community place. People are driving by that they didn't realize, and most practices grow with the relocation. So doing it a year or 2 before, you get that revenue boost, hopefully profitability boost, that's going to pay back some of the investment you put in there and a bump in the value. So if you can move before, I have another one where the zoning requires that the owner of the practice live in the property. So the owner wanted to sell the practice only and stay there. It's a nice property, but now they have to move if they're going to sell their practice unless they move the practice. If the value is low, how can you advise ways to increase the value? Most definitely. And that comes through in the income statement adjusted. That, to me, once we get to that true profitability, that income statement is my full blood panel on your practice. Because if you're not financially healthy, if your profits are low, what's suppressing it varies practice to practice, but it sticks out like a sore thumb to a good veterinary appraiser. So it's outside the scope of this conversation, but there are definite ways to bump that up. You can send me an email. I can get you some more information. Oftentimes, inventory, your cost of goods sold, is the number1 plague or disease for practice financial health. Good interest rate on a for sale by owner. I'm assuming this means that the seller is providing the financing. It should be at or pretty darn close to what you could get from the veterinary lenders, which right now 3.75 for a seller, then maybe 4.5. But it shouldn't be much more than that, in my opinion. Average time from first conversation to closing. Well, let me change that. Not from first conversation. From the time period that you decide, I want this practice and I can get the money. So you've done the work with the lenders. You're now engaging an attorney. As long as the attorneys play fair in the sandbox, 3-4 months, maybe 5, because we're starting with presenting the letter of intent. But that can shift, and that closing date floats. It's not cast in stone. The attorneys get busy. or issues come up, or the lender does, or the title company does the title insurance, but now they need a survey, or they do a phase 1 environmental and now we need a phase 2. A lot of things can creep up that can interfere. The quickest transaction I had was about 2 months. Everything went well. The longest was a little over a year because the attorneys, it was a mess. But it finally did come together. The buyer and the seller kept their heads through it all. Is there any market for a high profitable solo practice with gross less than 400K? It depends. Yes, but the number one variable when it comes to selling a practice, far and away any other variable, is geography. If you are in the popular part of your state, is someone likely to buy it? Possibly. I have a practice coming in the Cleveland area, what you just mentioned. However, I don't know how many buyers we have for Cleveland. So that's the unknown. It can sell. The other option is to do a merger with a larger practice nearby. That's win-win, because you sell your practice and they get instant revenue. It's highly profitable from their perspective. Exit plan webinar. Stacy, if you're listening, we need to do one. Is the evaluation affected if the practice is relatively new, say 5 years old? Now we're potentially, when a practice first starts up, we're looking at growth like that before we get to that stable ongoing. It's not a problem to value those kinds of practices. You just want to make sure you're working with somebody who has that knowledge and experience. A veterinary practice appraiser will be able to work on that. Examples of veterinary lenders. Yes, and now I was asked for examples. I'm not plugging anyone, although they're all very good veterinary lenders. Bank of America, Practice Solutions, Wells Fargo, Practice Finance. There's regional banks as well. First Command is another very good lender. If you want to email me, I can send you 3 or 5 or 6. We have a long list. Provide, formerly Lendeavor, is a very good one. Huntington Bank. These are veterinary specific divisions within each. Oftentimes they do dentists as well as veterinarian. In unique situations, I have specialty lenders that can do depending on the details, non-veterinarians. I've done one where the buyer had a bankruptcy 3 years ago. I work with a loan broker, Charlie Habush of Specialty Capital. He can help find folks to fit those special needs, extra low capital, especially in situations where you have no savings. SBA loans, Live Oak Bank is a phenomenal SBA veterinary lender. So there's a number of options, and I think looking at several is the best step. Is there an advantage to a gradual buy-in over a buy-out? I'm not a fan of gradual. If you're going to do it. 20, 48, 100. Or 20, 40, 100, whatever. The 5%, 5%. Every year you have to have a valuation, you have to have purchase agreements, you have to have attorneys. So do it. When you discuss that, when you have the first discussion, you should have the plan and not, well, we'll buy in 20% now and then we'll figure out the rest. As a buyer, you should say, okay, I'm going to get 20% now. When do I get my next 20%? And have that plan. Then review it annually. Or you said 3 years, it's now 2 years. Are we still on track? And make sure you kind of talk through that. There's a lot more on buy-ins to discuss, but we can schedule a call separately. How do you protect yourself from embezzlement working with a new staff? Checks and balances. Denise Tumblin has written a lot of good stuff on that. Marcia Heinke is another excellent consultant that has good content on protecting yourself from embezzlement and what you delegate versus what you oversee. Embezzlement's huge. Got to watch out for that. And the equine ambulatory practices, the valuation. There's different risk, number one. And I think somebody else had asked about earnouts. I often see in large animal practices, specialty practices, application of an earnout. And equine is similar, depending on what type of equine. Are you hobby horse, show horse, sport horse, etc. Those can all vary. But the concern in a transaction is that there's a lot of personal goodwill, because equine horse owners are different, and they're tied to you like a specialist as opposed to tied to the practice. So in those scenarios, we do see an earnout. What the earnout does, let's say your practice is worth $600,000. I'm concerned that I'm not going to get that. So we come to the table and I say, look, I'll pay you $600,000. I'm going to pay you $400,000 at closing. Then 12 months later, if the trigger happens, I'm going to pay you the other $200,000. Now, if you're going to do an earnout, I like a simple earnout, simple trigger. It's like gross revenues. So if your gross revenues last year were $750,000, then I may say if my revenues hit $700,000, 12 months after closing, then I owe you the other $200,000. If I don't hit $700,000, then I did not get what you had to sell, so I don't owe you. And there's all kinds of variations. What I like about this is it mitigates the risk for the buyer who has legitimate concerns, and it keeps the seller motivated to speak well of the buyer and transfer that goodwill. Ride in the truck together, personal introductions to the best clients, etc. So you come up with a plan and a client letter, etc., to try and make sure that goodwill transfers. How do you start a conversation with an owner and maintain confidentiality with his staff of 30 years? Definitely do not talk to the owner at the practice. You meet off-site, the two of you talk, and say, we need to keep this confidential. I will do that. Will you do so? And get a yes. And then, and even if they're too close with the practice manager, be specific. I mean, we do not tell Sarah anything until we get to this point. Are you in agreement? Don't make any assumptions. Get everything written out. Sonia McClendon, I'm not taking notes right now. Send me an information or send me an email for the slides. How would you engage in a merger? That's more than we can go in here, but if you send me a note, I have some documents, a PDF I can send you of general information. Corporate buyers look at $1.7 million practices with one full-time doctor. There are some that will, as long as you're willing to stay 2 years, or one year if there's a replacement plan. The sports medicine horses, that can be a little bit different because, well, send me an email on the equine. I can connect you with a few folks that can help better. Specialty practices. Can the same principles? Yes, the entire concept on value, transaction for specialty practices, it's very parallel. The exception, specialty practices, your clients are not the pet owners. Your clients are the referring veterinarians. And so taking that into account when planning the transition, personal introductions, letters to them, etc., that helps. Is Simmons able to find buyers for a seller who is working with Simmons? Well, that's our job. For my clients, and I have 30 some practices for sale, I just looked at my board. My job is to find buyers for them. And to that extent, we do. I have 250 people in the Great Lakes area, Michigan, Ohio, Indiana, waiting for a practice. However, they won't move. And so when it gets frustrating, I spoke with one of my clients today. We're starting year 3 of trying to sell his practice in Pennsylvania. Great practice, university town, growing, but no one wants to move there. And so it feels like we're bashing our heads up against the wall. We tried to buy a practice, single doctor, for $900,000. They wouldn't let me apply unless I had 10% in my bank. Some of the lenders do require that you have equity, 10% equity. So I have heard that before. One of the things to look at is some of the other lenders. The First Command, Steve Strickler has a lower equity requirement. Live Oak Bank has a lower equity requirement, but SBA has, well, SBA right now with COVID is actually starting to look really good. So I would look towards other lenders because not all lenders require the same level of liquidity. Yes, can you get the slides? Definitely send me an email. I'll turn this to a PDF and email it back to you. How do we determine average owner compensation? We look at owner compensation relative to their production and compensation rates in that part of the state. So they get paid as a doctor like everyone else. Is there an age after or years before retirement when purchasing a practice does not make sense? In general, most buyers are 5 years to 12 years out from school, graduation. Having said that, though, I sold 2 practices last year to folks that were out their first year. That's uncommon. And I've sold practices to folks who are out approaching 20 years. So it varies depending on how long do you want to work as a doctor? How long do you want to work as an owner? You know, I would think that you would like to keep your practice at least 5 to 7 years. Although I just sold a practice, I sold her the practice 7 years ago, and she said, okay, I came, I did it. I want to go do something else. And so we sold her practice. Sold it to the next buyer. So it more depends on some of your goals and timelines. Once we've found a practice, we are interested in who do we find to do the feasibility? A different broker. Yes. Now, unless I did it, because we do the feasibility analysis on every valuation. So, but having somebody review that is still wise. Summit Veterinary Advisors does this. You can work with another broker or just a veterinary consultant, veterinary practice appraiser, member of the Valuation Council. Almost all of them do feasibility, cash flow analyses. Denise Tumblin, Karen Felstead, Gary Glassman. There's 25 of us on the council, Camilla Bailey. So you can definitely find Glenn Hayner. There's more folks that can provide you that guidance to help get you through there. So I think that was a fun rundown, but that was all of them. Although I just saw more in the chat, but I think looking at those and given the time, that if they're yeah, I think most of these, it looks like people moved over to the Q&A. Oh, one that is good, a fair market rent for the lease. Thank you, Jordan. So when we're adjusting the income statement, we have to, if the owner owns the real estate, the rent at a minimum must cover the mortgage to purchase the real estate, whether you're buying it or not. But oftentimes we look at what's the value of the real estate, and then depending on the community, 8% of the value, 9%, 10% is a reasonable return on the real estate and covers the mortgage. So that would be the balance that we look at. So I know it's been long, almost hitting 2 hours. Thank you for so many of you staying on here as we go through this. One final plug that if you do want the slides, send me an email. I don't do anything with it, but I'll take the PDF, the PowerPoint slides, put that into a PDF and attach some more reading materials. I'll also attach Valuation Essentials, which is a publication by the Valuation Council. It provides more information on practice value and how that process unfolds. For the future owners, the other consideration, 2 last things for the future owners. Number one, the best time to plan your exits when you're planning your entrance. Give thought to how long do you want to own? What's my goal for buying this practice? Where do I want it to go? And the last thought, I guess, for future, all of you on here, involve your family, your household, your partner, your spouse. This is a life-changing decision, entrance and exit. You want the whole team on board as you go forward. That way you get the support, especially for future owners, because your first year of ownership, you're diving into the deep end of the pool and the practice needs to consume you. So for the first 6 months, you're going to have life out of balance for a while. And it helps if the home understands and provides that support. So I hope all got something from the session that made it worth the time. Thank you very much. And we'll try and keep some of these seminars going for you all. It's been a pleasure. I hope you got something from this.